Singapore Energy Week. Welcome, everyone. Now, the average price of Brent crude has been at $111 so far this year, crippling the GDP of several key emerging market nations. So says Richard Jones. He's the Deputy Executive Director of the International Energy Agency, and he joins me now in Singapore. Thanks very much for being with me.
Well, thank you for having me, Tara.
Now, first of all, let's get your outlook for oil prices in the year ahead. What are you anticipating, and how does China's growth fit into the mix?
Well, when we look at oil prices, we don't try and forecast. We just look at what the future price is, and we use that in developing our models. But basically, markets are tight. They're going to remain tight. For example, we look at the call on OPEC. We call it OPEC and stock draw, and it was averaging about 30.5 million barrels a day in September. And we believe that for 2012, it'll probably average about 500,000 barrels above that level.
So
the
prices
markets
will
remain
average
tight.
above 111?
Well, I mean, nobody is ever really sure what determines price. But tight markets mean higher prices normally, yes.
China factor, some seeing a slowdown in growth in China. Do you think that's going to have a large effect on the oil price?
Well, China, of course, has been one of the major markets that's been driving the tightness in the market. If China has a market slowing, that would take some of the pressure off the market, could lead to slightly lower prices. But I don't think I'd want to bet against Chinese growth necessarily. So the main thing, though, is that China can be a bulwark for the countries in the region, but it's going to be a key question for the evolution of the market, not only in this year, but for years to come.
Okay, with that key question in mind, and what sounds like I'm hearing from you that there will be relatively high oil prices going forward, what do you think would be the right price of oil, the kind of price that importers can handle and that also producers can use in order to be able to develop further products?
Yeah, well, obviously there are two sides of a coin, and the consumer wants prices to be low, to be reasonable, to allow them to carry out economic activity. The producers, of course, need the price to be high, enough to be able to make a profit, but also to be able to fuel the investment in future resources, which of course is also in the interests of the consumer. So there is a kind of a symmetry of interest between the producers and consumers. But at the levels you're looking at today, I think more and more we call it the oil burden, which is the proportion of a country's the proportion that a country's imports of oil represent of their GDP. And we've seen in the past that any time oil prices get to a level that the import burden is more than about 5% of GDP, that's bad news for a country.
So what would be a reasonable price where it doesn't live in the import burden, as you're saying?
Well, less than 5% of GDP, and of course that depends a lot on how import dependent the country is.
80 to 100.
Well, 80 to 100 is okay for some OECD countries, but for emerging markets it may be different. India, for example, has a particularly high proportion of imports, and I'm not sure what the number is right now, but we've been looking at India pushing maybe 6%. And so for India, maybe the price should be a little bit lower than that.
So it sounds like prices have to go way down in order for them not to be a burden.
Well, that's one of the reasons you're seeing pretty tepid growth around the world, I think.
We'll leave it on that note. Richard Jones, thanks very much for
you.
joining me. Richard Jones there, the Deputy Executive Director of the International Energy Agency. I'm Tara Joseph. This is Reuters.